The 6-month T-bill yield just collapsed to 1.47%. This is not just a number on a screen. It is the starting gun for an aggressive institutional rotation that is going to catch most retail investors completely off guard. Today, we are auditing 5 of the biggest movers on the SGX to show you where the smart capital is actually hiding. I had to run the numbers on this week's data twice. The gap between risk-free rates and banking yields is hitting levels we have not seen in a long time. This is one of those weeks where if you are chasing price momentum, you might be walking straight into a fortress wall. Let me show you exactly what the forensic data says. The Straits Times Index closed the week at 4,997.93. We are sitting in a protracted consolidation phase, exactly 1,002 points away from that psychological 6,000-point milestone. Broader market turnover reached 1.8 billion securities traded. That reflects a selective institutional flight to liquidity, and the single macro driver behind all of it is severe compression in short-term risk-free rates. The 6-month T-bill yield dropped to 1.47% at the 9th of April mass auction. That forced institutional capital out of structural risk sectors and directly into high-yield banking sanctuaries. Looking at the gainers this week, Oiltek International jumped over 20%. The catalyst was a transformational 1.4 billion Malaysian ringgit heads of agreement with Biosega Industries to construct a sustainable aviation fuel facility in Sabah, Malaysia. To put the scale of this deal in perspective, this single infrastructure contract is 5 times larger than Oiltek's entire 350 million Singapore dollar order book recorded in February 2026. It represents a massive acceleration above its 3-year historical baseline. Against an industrial benchmark like Seatrium, Oiltek passes our initial fortress threshold by keeping total debt below a 10% ceiling. But the visual of those industrial towers should not distract you from the valuation reality sitting underneath. When we dig into the forensic alert for Oiltek, we see a valuation problem that should make any income investor pause. We are looking at a trailing price to earnings of 104 times. The market is pricing in flawless execution. If we stress test a 10% timeline delay on that Sabah facility, a very real risk in today's supply chain environment, we could see an immediate and severe equity contraction. For a 55-year-old heartland investor putting 10,000 Singapore dollars here to secure retirement cash flow, a 1.4% yield starves your CPF timeline entirely. This is an alpha momentum play, plain and simple, not an income sanctuary. Oiltek represents the sharpest forensic contradiction on the local burst this week. The balance sheet is genuinely clean. The valuation is genuinely terrifying. A trailing price to earnings of over 104 times means the market has already priced in 2 years of flawless execution before the first turbine even turns in Sabah. One delayed shipment, one cost overrun, one regulatory hiccup, and that premium collapses without warning. A clean balance sheet does not insulate you from a valuation reset. If you are holding this for retirement income at 1.4%, you are not investing. You are speculating on management perfection. Next up in the gainers column, Geoenergy Resources moved up nearly 19%. The catalyst was an 18.4 million Singapore dollar private placement and the fact that their MBJ hauling road is now 80% complete. But here is the forensic warning. Their debt-to-equity ratio sits at 59.4%, well above our 35% fortress ceiling. That tells us heavy capital is being continuously recycled into infrastructure, not shareholder distributions. With a confirmed yield of only 1.34%, this counter is structurally useless for income mandates. You are taking on construction delay risk without being adequately compensated for the leverage being carried. Yangzijiang Shipbuilding also closed higher at 4 Singapore dollars and 9 cents. On record institutional demand for green methanol and LNG-ready vessels. Their fortress balance sheet remains solid. But the gap here is the yield. At 2.93%, it fails to clear our mandatory 4.7% sanctuary hurdle by 177 basis points. That gap forces a yield-seeking investor to sacrifice the minimum risk premium we require. Yangzijiang is a cyclical growth allocation for your portfolio, not a reliable cash flow generator for those of us looking for steady retirement income. If this forensic breakdown is useful to you, the single most useful thing you can do for the channel right now. Summarizing the gainers this week, Oiltek, Geoenergy, and Yangzijiang all showed strong weekly moves. None of them cleared the 4.7% sanctuary yield hurdle. Oiltek and Geoenergy show Altman Z-scores of 4.2 and 7.0 respectively. That keeps them on the watch signal list, but remember this clearly. A high Z-score tells you the company is unlikely to go bust tomorrow. It does not tell you the yield is safe or the valuation is fair. The forensic standard for a sanctuary has not been met by any of these 3 names. Moving to the losers, Olam Group took a 7.2% hit this week. We are seeing a leadership collapse. The chief executive, Chief Financial Officer and Chairman, all stepping down simultaneously in April 2026. Now, they reported a 414% net profit spike to 444 million Singapore dollars. Do not let that fool you. That profit was entirely engineered by a one-off Saudi divestment gain. Underneath that headline, core revenue has collapsed by 47% against the 3-year average. With a debt-to-equity ratio of 221.2%, Olam is a confirmed yield trap. That 5.1% payout is a mirage built on borrowed time. Olam is executing a controlled structural implosion wrapped in a divestment narrative. The simultaneous departure of the founding leadership is not routine succession planning. It is a complete reset of institutional confidence in a high-leverage growth model that has run out of runway. A profit spike built on a one-off sale, layered on top of a debt-to-equity ratio of over 220%, that is a major red flag. When that divestment cash runs out, that 5.1% yield has nothing structural supporting it. The debt wall does not negotiate. Turning to the other losers, Seatrium declined 1.6% to close at 2 Singapore dollars and 42 cents. An Altman Z-score of 1.2 and gearing of over 42% both breach our fortress ceilings. This validates our restructuring fatigue thesis. Zero yield while exposing you to refinancing risk. Then there is Green.ai, which dropped ahead of its AGM. It has a genuine fortress anomaly with only 1% debt. But the absence of any dividend creates a capital allocation void. For an income investor, receiving zero cash flow to offset inflation makes this structurally incompatible with retirement funding. Summarizing the losers this week, Olam Group is the standout yield trap, with a suffocating debt load of 221%. Seatrium and Green.ai both remain on watch signal status. Seatrium's gearing remains the primary concern for any long-term holder. Green's lack of yield remains the hurdle for income seekers. We are seeing a market that is brutally punishing high-leverage models that cannot guarantee cash flow. For the retail investor, these are the names that can drain a portfolio if you are not watching the gearing figures. This brings us to the forensic yield spread monitor. I apply a conservative floor of 3.2% because we audit for the storm, not just the sunny day. Even though the T-bill has dipped to 1.47%, we do not lower our standards to match a temporary market move. Our floor holds at 3.2% to ensure our sanctuary assets can withstand a return to long-term average rates. When you add our mandatory 150 basis point risk premium, our minimum sanctuary hurdle for this week stands at 4.7%. When we audit the yield spread for our banking anchors, DBS and UOB are the only counters that clear the bar as viable cash flow sanctuaries. DBS offers a 6.39% yield, a massive spread of over 3% above our floor. UOB also passes comfortably at 6.07%. OCBC sits at 3.61%. While it is above our 3.2% floor, it fails to meet that mandatory 150 basis point risk premium. This week, DBS and UOB are the confirmed sanctuaries for those looking for robust cash flow certainty. The macro connector here is a clear sector rotation signal I call the yield sanctuary squeeze. Institutional money is exiting structural risk anomalies and flooding into high-yield financial fortresses. And let's be honest, they are right to do so. The market is paying an extreme premium for zero debt growth while punishing endless corporate restructuring cycles. We are witnessing a systemic rejection of high-leverage models. The forward risk is a violent valuation collapse in those zero-yield engineering plays if their energy catalysts miss schedule. In this environment, absolute cash flow certainty is the only thing that matters. By the time this analysis reaches free subscribers, the entry window has often already opened and closed. The difference between finding a sanctuary and falling into a yield trap is often decided in a single trading session. In a market where institutional flight is this aggressive, timing is not just a benefit, it is the entire edge. Being an Iggy's Elite Investors member means getting these zero-day forensic breakdowns when the numbers still matter, not after the market has already priced them in. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you get the full red zone watchlist and institutional grade cheat sheets at the exact moment a setup goes live. The link to join us is in the description. My weekly verdict: the gap is currently 492 basis points wide. That is the spread between the 1.47% T-bill and DBS at 6.39%. When risk-free rates collapse this sharply, the premium on genuine distributable banking yield becomes an institutional magnet. While retail investors are distracted by momentum in mid-cap engineering plays carrying 104 times multiples, smart capital is quietly securing banking payouts regardless of rate headwinds. This confirms our wealth management hegemony thesis: in a squeeze, you want to be where the cash is guaranteed. I have rarely seen the sanctuary gap this wide. Do not get blinded by capital appreciation in companies carrying a suffocating debt load or a negligible yield. This dynamic is a forensic boundary I am tracking personally for my own portfolio construction, not a recommendation for yours. We are looking for the financial sector anchors to provide the stability needed while the rest of the market works through these high-leverage storms. The goal is always to protect the core while the rotation plays out. Every counter we discussed this week was stress-tested against our two-gate forensic framework before a verdict was issued. We look at the balance sheet fortress first, then the yield sanctuary second. If a company cannot pass both gates, it does not earn sanctuary status. This week has shown us that even in a consolidating market, the movements underneath the surface are violent, and they favor those who prioritize cash flow over speculative growth. Keep your eyes on the gearing. Never let a high headline yield blind you to a crumbling core. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.